due to some technical issues we've been having. It seems like even after more than a year in this virtual environment, it's still not always as easy to work in this way. Let me kick off with a couple of logistical notes before we start the actual session. So all of you will be in listen-only mode, but you will be able to ask questions via the chat function. And the event will also be recorded and published on the IAIS and SIF websites. Anyone that is connecting by phone or in other ways is unable to see the presentation and the slides on your screen. You can go to the IAIS website under stakeholder events, and you can download the PowerPoint presentation there as well. I'm getting some background that I cannot be heard. So I'm handing over to Peter Koolhagen now, and I hope the sound will work fine for him. Peter, the floor is yours.
Thank you, Hannah. Okay, we just got a message that the sound's working, so that's a good step. So welcome everyone. My name's Peter Koolhagen, one of the co-chairs of the drafting group that led the work on the application paper. So can we just flick to the next slide? We'll just talk briefly about the agenda for today. So as Hannah mentioned, we've had a few technical issues, so we are going to just slightly rearrange the agenda. So we'll first talk about the application paper and the background to that and the consultation process. And then hopefully we'll come back and hear from Anna Sweeney, the chair of the Sustainable Insurance Forum after that. And then finally some closing remarks from Connor Donaldson from the IAIS. So just a few brief introductory comments about the Sustainable Insurance Forum and the IAIS. The Sustainable Insurance Forum is convened under the auspices of the UN, and it's a group of supervisors who have common interest in sharing learnings and discussions about issues related to sustainability in the insurance sector. So for obvious reasons, climate risk is and has been an ongoing focus of the Sustainable Insurance Forum. And the Sustainable Insurance Forum has worked in very close partnership with the IAIS over recent years to deliver a range of papers and materials around the issues of climate risk. So the Sustainable Insurance Forum has at the moment 31 jurisdictions and an ongoing program of work to develop the supervisory understanding of climate risk and sustainability issues more broadly. And just have the next slide, please. So as I said, the Sustainable Insurance Forum and the IAIS have been working in close partnership on issues related to climate risk over the last few years. And that has resulted in the release of 2 issues papers. The first one was a general paper on climate change risks to the insurance sector, which was released in 2018. And then a more specific piece of guidance in an issues paper on implementing the recommendations of the Task Force on Climate-Related Financial Disclosures into the insurance sector in 2020. And then over the past year or so, we've been working closely to develop an application paper on supervision of climate-related risks in the insurance sector. We consulted on that last year, and we'll talk more about the outcomes of the consultation in a little while. But we did receive a lot of consultation feedback, which was very useful. And the final version of the paper has been published in late May. And I certainly commend the paper to you if you haven't had a chance to read it yet. So we'll now turn to talk more about the contents of the application paper itself. I'm going to introduce and hand over to my co-chair of the drafting group, Emmanuel Rocher from the ACPR, who's going to take us through the next section of the presentation about the paper. Thanks, Emmanuel.
Okay, thank you very much, Peter. I hope you can all hear me. So hi to everyone, and thank you all for joining. So let me start by saying that this application paper on the supervision of climate-related risks in the insurance sector has been written jointly with the IAIS and the Sustainable Insurance Forum members. It mainly deals with climate-related risks from a governance and risk management perspective. First of all, I would like to remind you that the aim of an application paper is not to set up new standards insurers should comply with, but instead is to provide insurance supervisors with additional guidance and material, including example of good practices or case studies, in order to help the practical application of the insurance core principles, the ICPs, developed by the IAIS. So we started from the generally accepted principle that climate change and climate-related risks are a source of financial risks that have an impact on the resilience of the individual financial institutions, such as the insurers, naturally, as well as on the financial stability. So climate-related risks affect the valuation, for instance, on the insurer's assets and liabilities, and increases the cost of damages. So the scope of the paper is divided into 5 main areas. I will speak briefly on the first 2 bullet points you see on the screen. The paper focuses on the way to integrate properly climate change matters into the decision-making process, and into the governance framework. Quantitative aspects have been intentionally left out of this paper, but could be subject to future works. So by developing this application paper, we really tried to help supervisors and insurers implement new governance and risk management monitoring tools to face these risks related to climate change, and to provide concrete examples to illustrate the way the different requirements can be set up and implemented in a proportionate manner. So we can now switch to the aspect related to the supervisory review and reporting. So when integrating a climate risk perspective into insurance supervision, we saw that supervisors should first assess the external environment and how this may impact the effectiveness of any supervisory initiative. They should evaluate the need for additional resources and training opportunity for the staff, if necessary. They should also have a clear view on the relevance of climate-related risks to their supervisory objectives, including the policyholder protection and financial stability. We came to the conclusion that supervisors and insurers should develop quantitative and qualitative tools to assess the exposure of the insurance sector to financial risks coming from climate change. For instance, this paper recommends using climate stress test scenarios. The application paper also provides examples of relevant indicators and sources of information that could be useful for the supervisors. I think we can now, yes, move on to the question of the corporate governance and risk management areas. So on corporate governance, the application paper recommends that, for instance, the insurer's board members, collectively and individually, should be aware of climate-related risks and its consequences on the business conduct and the solvency position of their undertakings, and if relevant, adequate trading can be naturally envisaged. In order to do so, the governance framework shall first define in written policies the proper role and responsibility of each member and of the board as a whole regarding climate-related risks, ensure by clear processes that climate-related risks are well taken into account in the decision-making process, for instance, through the approval of the risk appetite framework, and ensure that the board is provided with relevant qualitative and quantitative data and adequate information given by the senior management and the internal controls. Climate-related risk issues and objectives can also be taken into account in the remuneration policy of the undertaking with dedicated criteria within the variable remuneration framework, for instance. Under risk management and internal controls, it is recommended that control functions take into account climate-related risks when performing their tasks. So, for example, the compliance function should make sure it takes into account the reputational and liability risks stemming from climate change. The actuarial function should pay a particular attention to the assessment of the underlying data on climate-related risks, and in particular for the calibration of the premiums. It is important to consider forward-looking data, in particular where historical data are not considered as sufficient. And the staff in charge of the control functions should also have the relevant experience and knowledge in understanding the climate risks and their impact on the insurers' risks and activities. Insurers in particular should then adapt their internal policies and implement training programs to ensure they have a sufficient understanding on this issue within the internal control functions. Let's maybe now have a look at the question of the internal enterprise risk management that is on the next slide. Yes, thank you. On the enterprise risk management, the paper expresses general views on the fact that the enterprise risk framework should properly identify, assess, and monitor climate-related risks. In particular, supervisors should expect insurers to identify the relevant climate-related risks in all their dimensions, notably in particular when I think about the physical, the transition, and the liability risks that are inherent in their business portfolios. It is also expected that the author contains an assessment of the impact of the climate change on the solvency position of the undertaking using adverse scenarios. Another recommendation states that it is expected that insurers consider and document in the risk management policies and procedures how climate change and climate-related risks could materialize in each area of the risk management system, and in particular in the investment and underwriting policies. So insurers should be able to assess the implication of the climate-related risks for their underwriting strategy and develop adequate policies and procedures to integrate the management of this risk within the ERM framework. On all these issues, I will stop there and give the floor to Peter back again on the different aspects that are still on the paper, on other aspects, on the issues. Thank you so thank you all, and Peter, you have the floor now. Thanks.
Thanks, Emmanuel. So we'll turn now to investments, and so ICP 15 and 16 have standards related to investments that are relevant for in the space of climate risk. These include requirements around having appropriately diversified investment portfolios that allow for payments to policyholders as they come due to invest the assets of the insurer in a manner that's appropriate to the nature and duration of the liabilities, to be able to properly assess and manage the risks associated with the investments, to have an investment policy as part of their ERM framework, and similarly an asset liability management policy. And so the paper concludes that as supervisors assess these aspects within an insurer, it's important to consider how the insurer is taking into account the potential impacts of climate risk as it makes its investment decisions. And clearly, the value of the insurer's investments can be impacted both by physical risks of climate change, but also transitional risks from the transition to a low carbon economy. So the paper recommends in this regard that insurers assess the impact of these risks on their investment portfolio, and also on the impact that these risks might have on the extent of asset and liability matching. And then the paper discusses the role that scenarios can play in producing a forward-looking view of these risks and helping insurers to understand the impact that they may have. Have the next slide, please. So ICP 20 is about public disclosure, and it includes a range of standards that are relevant, again, in the climate risk context. So it includes requirements for insurers to disclose information about their corporate profile, including the external environment that impacts them, their corporate governance framework, exposures to insurance and investment risks, and information about their investments. And it follows from the conclusion of the paper that the climate risk is a material financial risk for insurers, that there should therefore be disclosure about information relevant to climate change as part of these disclosures. And this is particularly important in the context of a risk that is evolving rapidly, such as climate risk, where it's key for market participants, supervisors, policyholders, and other stakeholders to be able to come to a more full understanding of the potential impacts of the risk and make appropriate decisions. Clearly, the impact of the risks will differ depending on the business model of insurers. And so for some insurers in particular, the impacts may be more significant on the insurance and the liability side of the balance sheet, and others may have relatively more impact on the investment side. The paper discusses the TCFD framework as being an example of a framework that facilitates disclosure of climate risks, and it's one that is becoming increasingly accepted in the supervisory community as being an example of good practice in this regard. The paper, as across most of these issues, includes a range of examples that have been drawn from the experiences of supervisors from the Sustainable Insurance Forum to provide guidance to supervisors about how these requirements can be implemented in a proportionate way. Just have the next slide, please. So I'll talk a little bit now about the outcomes of the consultation. As I said at the beginning, the process was very fruitful. We received a large number of comments from a wide range of different stakeholders, and lots of thought-provoking and useful feedback that has enhanced the paper. The high-level message was that the feedback was strongly supportive of the work that the IAIS and SIF had been doing on climate risk, and that the paper was a useful addition to the literature in this regard. Some of the comments more specifically discussed potential refinements to terminology and how climate risks can be mapped into the existing risk management framework. We received feedback that it was important to recognise the importance of cooperation, not only on a cross-jurisdictional basis, but also on a cross-sectoral basis. We received feedback that it was helpful for the paper to recognise more explicitly that the disciplines around measuring and addressing climate risks is an evolving area, and so that expertise will continue to grow over time. And so we've made some changes to the final version of the paper that reflect this feedback. Just following on a few more comments here, we have there was some feedback around the prescriptiveness of the disclosure section of the paper, which we've made some refinements to more explicitly draw out considerations of materiality and improve alignment with ICP 20. There's been some refinements also to the paper in regard to remuneration policy and stewardship issues to reduce the level of prescriptiveness there. And we've also, as the slide notes, incorporated some further examples and clarifications that were suggested. And so if you're interested in understanding in more detail the responses to submissions that we received, there's some material about that on the SIF-IAIS website that you can look through. So with that, we might turn over to some Q&A. So Emmanuel and I are happy to respond to some questions. We get some through the chat.
Peter, I don't know, maybe I get it wrong, but I think that Anna Sweeney from the Bank of England wanted to say some words on the work around the application paper, and then we could after that move to the questions, if it's fine for everyone.
I think that's sensible. So perhaps people can add some questions into the chat box while Anna speaks. So I will hand over to Anna Sweeney. Anna is the chair of the Sustainable Insurance Forum and an executive director at the Bank of England. So Anna, over to you. Welcome.
Thanks very much, Peter. Thanks for a great presentation. I'm sorry I missed the beginning piece of having serious technical issues managing to join the call, but I'm very glad to be able to do that. Finally, I just want to say briefly thank you very much to all of you from standing all over for the world, from data supervisors, insurers, and other stakeholders with a keen interest in climate risk in the sector. That's particularly, we have an audience for the issue, and that it's a global problem that we're facing and requires all of us to coordinate to respond in a consistent and effective manner. So just wanted to reiterate thanks to the both SIF and IAIS for organising the event. Having taken over, as Peter said, as chair of the Sustainable Insurance for the beginning of last year, I've already seen the importance of partnership between the organisations, combining knowledge, experience, and enthusiasm. Most importantly, of these groups means producing tools to implement supervision of climate risks across the world. Builds that this important work as more audiences as possible. Prime example of the success of the relationship through the application of the system of climate-related risks in the insurance sector. The reason that we're here today, obviously, and it's part of this launch of this historic market, the first application paper for supervision of these important risks from an international standard-setting body. It's incredible to note that since its recent launch, the application paper has already been studied nearly 2,000 times. The application paper provides supervisors with more certainty in their approaches to assessing and responding to climate risk within their own jurisdictions. In the IAIS core principles as the basis for the paper, focusing supervision of these within established work, and that helps supervisors understand how climate risks arise, how to address them. Both supervisors and insurers can take insights into how to address climate risks, supervisory reviews, corporate governance management, scenario and stress testing, as well as investments and disclosures. And all of these areas are important, and I encourage you to review the paper and its recommendations if you haven't had the chance to do so. I consider this paper to be representative of the kind of work we're proud to see this deliver. We represent the latest thinking and regulation and supervision of climate risks within the sector. Facilitate the sharing of information, ideas and practices among members, helping to build capacity among the members and the sector as a whole when it comes to addressing the climate change poses to financial resilience. Also, we support implementation solutions to address these risks. It's with this in mind that I'll conclude these remarks. I congratulate the drafting team, including Peter and myself for leadership and achievements in delivering the paper. I challenge everyone attending, including me and the team, to consider how we can move into implementing practical responses to the risk across roles. Thanks again for attending, and I look forward to seeing the rest of the discussion and the questions that you raised. Thanks, Peter. Back to you.
Thanks, Anna. That's some helpful context. So we are now moving to take some questions, and we do have one in here that perhaps Emmanuel, you could touch on, given it relates to ERM. But on the question is about can we have a bit more about insurance risk and any commentary on identification, assessment and monitoring of insurance risk and how that's dealt with in the paper?
Yes. Would it be possible to elaborate a little bit more on the question, because it does not sound so clear to me?
So perhaps the person who asked that question might follow up in the chat, and we can take it then. So the question's coming through quite quickly now. I'm just trying to keep across them. So we have quite a few questions here about the IIS's future work program. So we are going to be joined by Connor Donaldson from the IIS, who will be well placed to speak to what future work the IIS is planning to do on these issues. I'm not sure, Connor, whether you want to speak now or do you want to hold that until your closing remarks?
No, thanks, Peter. I'm happy to come back to them with my closing remarks, and we can keep focused on the paper at this point.
So we have one question here about what are the more controversial topics or recommendations in the paper, and from the supervisor point of view, where might they be likely to expect some level of concern from insurers? And perhaps Emmanuel would like to add, but I think a couple of the issues that did generate quite a bit of commentary in the consultation process were around the role of remuneration policies in managing climate risk, where that's obviously a very emerging area, and there was some lack of clarity, I guess, from people about how that might work, which we spent quite a bit of time on in the process of considering the feedback. And another topic was around the role of stewardship from insurers, and particularly how that relates to the mandate of supervisors. those were a couple of the issues that were generated particular comment. Emmanuel, do you have any further views on issues that were particularly contentious?
No, I fully agree with you. Yes, there was this idea, the question around the remuneration policy. But as you said, I mean, the paper is not prescriptive in this area, and we gave some examples or some clarification around what could be considered within the remuneration policy and based on non-financial and climate-related risks. So we'll try to be as consensual as possible on this topic.
So there's another question here, which to summarize says that the paper focuses a lot on the solvency governance and liability risks from climate change, and but the question is around, is there work being done on potential market conduct implications of the risk, and how supervisors responsible for market conduct can respond. This is an area that was not covered specifically in the application paper, but that was not in a comment that we don't consider those issues important. There are material issues around market conduct, and particularly questions around disclosure to policyholders are relevant in that regard. Questions of greenwashing, etc. So there is, there are issues around market conduct that are potentially fruitful avenues for future work in this regard. Certainly in Australia, my authority APRA cooperates very closely with the market conduct supervisor to make sure that we're taking a coordinated and consistent approach to climate risk. Any questions in here, Emmanuel, that you would like to pick up?
Yes, maybe there's a question around the role that that supervisor could have in facilitating the transition towards a green economy, and what is in the prudential framework to support the green transition. I mean, as I said, perhaps at the beginning, if you remember that, we did not include in the paper quantitative requirements or try to develop this aspect of the prudential framework. So the application paper is not a standard that has to be applied and set forth in the jurisdiction. It is I would say a guide for supervisors to help the supervisors ensure understand all the different aspects of climate change transition and how this may impact the insurance industry. So it's not part of the prudential framework that has to apply in specific jurisdictions, but to some extent and indirectly, I would say that this application and paper and all the work that is done by the SIF-IAIS can contribute to the transition towards low carbon economies, but it's an indirect role and not a mandatory objective of this work through the application paper or other work done by the SIF-IAIS. But Connor, if you want to complete me on this aspect, but it's part of the efforts from the supervisors community to help the insurance industry move towards a green transition.
So there's another question here around use of climate scenarios, and do we think that changes in practices as a result of the application paper might encourage more investment into integrating future climate scenarios into modelling? I think that's certainly would be an aspiration. There's a lot of work going on at both at an international level, but also individual jurisdictional level to really encourage improvements in capability and capacity around being able to do that sort of climate scenario modelling. And I think that's a really important step for insurers to take to drive more meaningful disclosure and more meaningful management and understanding of the risks. So I'd certainly hope that there's an improvement in that over time. Another question here around stress testing. So is it the intention for insurers to choose sort of individual bespoke scenarios to do the testing, or will supervisors issue sort of industry-wide generic scenarios? I think we're probably seeing a mixture of both of those approaches being taken at the moment. Certainly, I know a lot of insurers are doing work on scenarios, and importantly for them to do so to be able to disclose in accordance with a framework like the TCFD. But a range of supervisors around the globe, and there's a question here that touches on the PRA scenario, and in Australia, APRA is also doing a more generic scenario. So I think we're seeing practice emerging that that both of those types of stress testing are important.
Maybe again on stress testing, as some of the participants may know, the ACPR in France has developed very recently a new stress testing exercise for insurance and the banking sector also, and we relied on the scenarios developed by the NGFS. So there's no purely generic scenario developed by supervisors, but there is already the NGFS scenarios for the transitions, and that could be the basis for many other insurance stress testing exercises globally.
So there's a question here about is there consideration of different treatment for life and health insurance versus P&C or general insurers, given the different types of exposures they might have to climate-related risks? And the answer to that is, I think, yes, that there's a strong recognition in the paper that different business models, different types of insurers will be impacted differently by climate risks. Some insurers will have a business model that's more exposed to transitional risks on the asset side. Some will have particular exposures on the liability side. So the paper is designed to be helpful to supervisors as they look at both or all of those different types of business models. It's not prescriptive about a particular single type of business or business model. Emmanuel, any more that you're seeing there that you think would be helpful to respond to? We've got quite a lot of questions.
Yes, perhaps just one comment related to the question. regarding, I mean, the question of the double materiality. I saw this question in the chat, and which is related to the impact of climate risk on insurers, but also reversely the impact of the insurance, the insurer's portfolio on the climate, I would say. This was a very interesting question. I must say that when we spoke together at the beginning of the chat, the Q&A session around the controversial issues, there was also this question of the double materiality, and the participants may know that we have to admit that double materiality or simple materiality is one of the questions that are not, I mean, raising consensus at the international level. So that's the reason why actually we decided to concentrate rather our work on the impact of climate on the insurance balance sheets, because it's not something that is the double materiality is not something that is considered as the same priority within the different jurisdictions. But you may know that in Europe, the double materiality is something that we have taken into account in the disclosure requirements and in the next directive that are on the way to be applied to insurers and banking companies. Thank you.
So a couple more questions here. One is about what does the paper have to say about use of non-financial indicators to assess the contribution of senior managers and board members to a more climate resilient and sustainable insurer? This question goes to the comments about remuneration. So that there is some discussion of these issues in the paper. I think, as I noted earlier, it's probably an area of practice that's still developing. But I think the principle that remuneration structures in use at an insurer should incentivize appropriate risk management and the taking of a sensible long-term view of risk, I think are relevant to consideration of climate risks also. So we've got a question here around, how do we think of climate risks as systemic risks? So perhaps I can make a few comments, and perhaps Emmanuel would also like to add on. But to my mind, the systemic nature of climate risk is really around the way that it impacts across on a global basis and across sectors and across all types of insurers. So it's not a diversifiable risk in that sense. So I think in that sense impacts at a system-wide level and is perhaps particularly difficult to manage from that perspective. And I think that's just adding on to that. I think that's one of the reasons why the IIS and SIF have taken such a close interest in this particular risk. It's a global risk. It's particular level, and the work on things like the application paper and other related work that the SIF and IIS are doing is designed to really lift the global level of understanding and practice around these risks. One, getting the comment that when we have Emmanuel, I'm not sure if you've seen the one here around the ACPR stress test. You'd be better placed to answer that.
Yes, I would have been keen to answer the question, but I have to say that I'm not a specialist of the stress testing at the ACPR. Sorry about that. So on the disruption risk, I can't really answer the question, but I will ask my experts. But sorry, I can't take the question. Sorry for the audience.
Thanks, Emmanuel. So I think that probably brings us to the end of our time for Q&A. So I'm going to introduce and hand over to Connor Donaldson, who's joined us from the IIS to close the session. Thanks, Connor.
Thanks very much, Peter. And just I was having some audio earlier, so I just want to make sure you can hear me okay. Perfect.
I can hear you well, yeah.
So good evening, good afternoon, and good morning. Thank you again to all of the participants who have joined today's call. Let me start off by saying a big thank you to Peter and Emmanuel for their leadership in developing this paper, and to our members and to our stakeholders for their contributions. As I think as a result of the interest and the contributions we received, we ended up with a very strong paper, a very thought-provoking paper, and one that I hope is very informative, not only for insurance supervisors, but also for policymakers and industry. At the IIS, our focus on climate risk and sustainability goes to the heart of our mandate to support our members as they protect policyholders, support fair, safe, and stable insurance markets, and contribute to financial stability. This application paper is part of a journey for the IIS. We very early recognized the need for action on climate change. When the IIS began to develop our 2020 to 24 strategic plan, we had just published our first paper in partnership with the Sustainable Insurance Forum, which looked at climate change risks for the insurance sector. This paper established the foundation for the IIS ongoing work on climate, and of course for our partnership with the Sustainable Insurance Forum. Climate risk was identified as a key strategic theme for our 2020 to 24 strategic plan. When 2020 began, our focus was really on delivering, making that transition towards delivering on our new strategic plan. And like most of the world, however, we had not anticipated that we would immediately find ourselves in the midst of a global pandemic, particularly one with such severe social and economic costs. While 2020 turned into a year of responding to the immediate effects of COVID-19, one thing remained very certain, that despite all of the issues and challenges we faced, the recognition of climate risk as one, if not the most pressing risk, remained. Further, the pandemic highlighted that tail risks do crystallize, and if anything, I feel confident saying it has only increased the pressure for action on climate. As I said, the appetite for action is increasing. Now, maybe it is because all of us are beginning to see the effects of climate change in very visible and material ways, be it devastating wildfires such as those in my home province of British Columbia, Canada, increasingly severe droughts and flooding, or increasingly severe weather events. It's very clear that the world is at increasing risk, and now is the time for action. Recognizing the risks, it's clear that supervisors really do play a critical role, not only as microprudential supervisors, ensuring that insurers are appropriately managing their exposure to climate risks, but equally important from a macroprudential perspective in assessing, understanding, and helping mitigate the impact of risks across the financial system. I'd like to just briefly mention the IIS's ongoing work in the macroprudential and microprudential space, the work that we're doing in collaboration with some of the other international organizations looking at climate risk in the financial system, and finish off by highlighting a couple of points on the IIS's future work in this area, as I know that it was a question that came through in the chat. So in terms of macroprudential assessment and monitoring work, this year the IIS will undertake a deep dive analysis on the potential financial stability implications of insurers' investment exposures to climate-related risks as part of our global monitoring exercise. Now, this work's in early stages, but I'm confident that it's going to provide some very significant insights. In terms of our microprudential work on supervisory standards and practices, with the application paper, which is today's focus, we hope that the IIS will help guide the actions of insurance supervisors to better understand and manage climate risk, supervisory reporting, governance and risk management, investment policies and disclosures. And I really find that the practical examples in the paper should be incredibly valuable for supervisors as they think through their own responses and how they integrate climate-related risk into their supervisory framework. It's also clear that enhanced transparency on climate risks is critically important from a microprudential perspective, as it is a critical precondition for the effective pricing of risks and appropriate market discipline. In addition to how this application paper touches on disclosure, I wanted to take a moment just to highlight that in 2020, February, we did publish a paper on the implementation of the TCFD recommendations in the insurance sector, again, in partnership with the Sustainable Insurance Forum. That paper does provide an overview of practices that supervisors have considered in the development of climate-related disclosure requirements, but it is indeed a fast-moving space. So while I think it's a helpful read, I think all of us recognize that there has been a lot of action in this space over the course of the last year. Last December, the IIS also publicly welcomed the proposal by the trustees of the IFRS Foundation to establish a new sustainability standards board to contribute to the development of global sustainability standards. The lack of a globally accepted framework for sustainability standards is one of the obstacles to disclosures that are comparable, reliable, and of sufficiently high quality. I believe that the creation of the Sustainability Standards Board under the IFRS Foundation will be an important step towards a globally accepted framework. Now, regarding collaboration, of course, we have a very strong relationship with the Sustainable Insurance Forum. But we recognize that with a topic as complex as climate, multi-stakeholder approaches are critical. So we are active participants with the Financial Stability Board and the work that they've been doing on climate change. And also we are active participants in the Network for Greening the Financial System. In both the FSB and the NGFS, the IIS is really trying to bring an insurance sector perspective and a supervisory perspective to these discussions. So in closing, let me just say a couple of quick words in terms of what's next for the IIS. As I mentioned, the challenge of climate change is so big and so complex that we must take a multi-stakeholder approach. So in addition to our continued collaboration with the Sustainable Insurance Forum, we'll also continue to work collaboratively with industry and with policymakers and work cross-sectorally through the FSB channels as well as through the NGFS. We'll also continue our collaboration with other partners such as Financial Stability Institute and the Access to Insurance Initiative, as well as others who are working in the capacity building and technical assistance space as they work to support insurance supervisors take further steps to address climate risk. We will also, over the course of this year, set out further planned work, focusing on activities that will support our members to meet our core objectives, to protect policyholders and maintain financial stability in the face of the unprecedented risks posed by climate change. Let me just say in closing, again, a big thank you to everyone who joined in today's call. The IIS is, of course, very committed to robust stakeholder engagement. I find platforms like this, discussions like this, to be incredibly valuable. And what I would also say is that we have a number of opportunities, of course, over the course of the year to hear from our stakeholders We have our global seminar coming up towards the end of this year. We have an event, towards the end of this month. We have an event coming up next week with the Principles for Sustainable Insurance, as well as with the SIF. You can find information on the slides here, as Hannah has helpfully put up. But I also say we'll have, of course, our annual conference towards the end of this year, where again, I think we'll have the opportunity to talk about the work of the IIS on climate, hear views from our members and from our stakeholders. So hopefully, Dave, I've addressed your point, a strong commitment on our part to support stakeholder engagement and continue the conversation. And we really do recognize that insurance industry, supervisors, and policymakers all have their own role to play, but I think it's one where the effectiveness of us delivering on what we need to deliver in the face of climate change really does require us to recognize that we do have complementary objectives in a number of ways, and I think the strength of our action is incredibly strong when done collaboratively. So thank you again, everyone, and thank you, Peter, Emmanuel, again for your leadership, and thank you, colleagues, for joining in today.